Okay, well, I make it 10 o'clock. Let's get started. Welcome to our webinar this morning. I'm delighted to welcome you to our presentation on tax tips for the year end. I'm joined this morning by Matt and Corné, both Associate Directors at M J Bushell. So welcome to you both, and thank you for doing this presentation for us this morning. Just a little bit of housekeeping. We will have a live Q&A session at the end of the presentation today. So as Matt and Corné are doing their presentations, if you think of any questions that you'd like to ask, the way to do that is on your Zoom toolbar, you'll see a Q&A option. If you click on that, that allows you to put your questions forward throughout the presentation. And I'll come back at the end to have a look at how many we've got. We'll try and answer as many live as we possibly can. We are also recording this webinar today, so we'll make a copy of this available on the website later on. So if there's anything that you want to sort of recap on or go back to, then that will be available as an on-demand version for you. So at this point, I am delighted to hand over to Corné and Matt, and good luck, and I'll see you at the end of the session today.
Brilliant. Thanks, Jo. Morning, everyone. So yeah, the purpose of this webinar is to quickly run through some general tax tips that aren't solely related to the end of the year, but more as general points everyone should be considering throughout the year. And I've got a quick summary there of our agenda this morning and what we'll be covering. So taxation, something that was drummed into me quite frequently while I was studying is the 7 deadly taxes listed there on the left-hand side. We'll go through most of these throughout the webinar in brief detail because obviously of the timing. So before we crack on with the tax planning element, a key point to know is, or a quote that I use, that sometimes people laugh at me, but I know I use it quite a lot, and I know a few financial advisors that do, is don't let the tax tail wag the dog. But what I mean by that is smart tax planning is fantastic, it's key, but your decisions should never be business, lifestyle-wise, should never be solely just because of tax. I've sat with clients that have said, I don't want to pay inheritance tax, I'm going to move overseas, I'm going to move to a tax haven, Panama, Gibraltar, just to avoid tax. And my question was, well, do you really want to live over there? And the answer was no. So tax planning is fantastic, but it should never be your sole focus. So starting us off, corporate planning, whereby we're thinking of business owners that trade through a limited company. And a frequent question that I get asked, and I think we all normally get asked in the accounting profession, is how do I get my money out of the company tax efficiently? And the key point really is, and I hope everyone's familiar with them, is the income tax threshold. So when you take money out of a company, we're looking at our normal income tax thresholds, the ones that apply to everyone. Whether you're POE or a company director, these thresholds apply on income you personally earn. So the key brackets or numbers here are the personal allowance of 12,500. So everyone can earn that tax-free. So 12,500 as it stands at the moment is tax-free. Your next rate is then the 50,000 mark, where you're still classed as a basic rate taxpayer. So maximum 20%, for dividends it's 7.5%. And then you're looking up to the 100,000 mark. And a reason I put the 100,000 mark in there is that is not a widely publicised threshold. You'll not see it in any HMRC guidance. It's not that 60%, that big bold red 60% there is not a widely publicised tax rate. You won't see it in any of your tax rate cards. So it's a bit of a stealth tax, if you like. And how it works is that for every £2 you earn over 100,000, you lose £1 of your personal allowance. So what does that mean? Well, you carry on paying tax at your normal rate, which is 40%. But that personal allowance that was tax-free, that 12.5, suddenly starts to become taxable at 20%. So in between 100 and 125,000, on that 25,000 slice, you effectively pay tax at a rate of 60%. So what do we do, and what do I advise clients? So a big part as a company owner is that question: how do I get my money out tax efficiently? And it's all about looking at those income tax thresholds, those bands I've just gone through, and how do we year on year make sure we're keeping our income in those thresholds and so as tax efficient as we can. So the starting point is always a salary. So as a director owner, you should always have a basic salary going through the business. And the rates really that I was looking at is 8788 between that and 12,500. Now the 8788 might sound like a bit of a funny number, but the reason that is the lower limit, if you like, is anything you earn over that starts to be subject to national insurance, employers' national insurance and employees' national insurance. So there's not a big deal between the 8788 and the 12.5 in tax, but you don't want to be paying yourself more than that 12,500 in salary. If you have the option to not, basically, that's where you want to put yourself as a salary. No income tax falls within your personal allowance, maybe a small bit of national insurance, and in addition to that, you get something called a state pension credit year, which basically means when you reach, I think it's 66 now, the government, if you've got 35 full qualifying years where you've earned over that threshold, you get the full state pension. So that's, your starting basic level. Everything over that you want to take as a dividend. And what is a dividend? Well, a dividend is a voting of profit. So your company must be profitable. The first 2,000 dividends are tax-free every year. And then as the rates there, your next, if you like, between 12.5 to 50, you're at 7.5%, and everything over 50 is at 32.5% until you're earning over 150,000 when you pay tax at 38.1%. Now, key point to note with dividends is they're taxable, or they fall within the tax year when they're voted, not when they're physically paid, and that's a big differential. And I know a lot of people, they vote a dividend and they pay at the same time. You do not have to do that. You could vote a dividend now, for example, but you could take that a week down the line, a year down the line, 3 years down the line. When it's voted, that sits as an amount owed to you to be taken whenever you want, and vice versa. You can physically take money out of a company and pay a dividend later down the line. So say someone's at their £100,000 mark at the moment, they don't want to take out more dividends, but they need some cash. Sure, they could take some money out of the business and push that dividend on 6th of April and actually defer the tax a whole year. So they could take the money out early and put the dividend through, a few weeks later to defer the tax and crystallise a lower rate. So a big planning point normally when we're talking to clients is, when do we take our dividends? How do we plan? And looking at those income tax thresholds. To give you an example of someone here, this was a good example. Someone basically falls within that tax trap. So over a 2-year period, they want to take 250,000 out of the business. So if you split that evenly, it's 125,000 each year. So in those 2 years, at 125,000, they are losing their personal allowance. They're in that nasty 60% bracket. What you could do, or what we'd advise, is you do high years and low years. So even though you want to take 250 out, you can split that however you want over 2 tax years. So in that situation, if that was the case, it's probably an unlikely situation, but you do a high year, you maybe take 150,000 out of dividends, lose your personal allowance, fine, it's gone. And then a lower year at 100,000, keeping your personal allowance. So you've still taken out 250,000 over the 2 years, but by doing a high year and a low year, you've actually saved yourself 5,000 in tax just by managing your income levels. So that's a key point, I think, in terms of avoiding that 6% threshold. But for most individuals, where you really want to be doing is every year we want that salary up to your personal allowance, and then we really want to be using every year that 50,000 threshold, that 7.5% dividend band. To waste that, especially with probably taxes on the horizon in the near future, even if you don't want that money out, it makes sense not to waste it and to use it now. So you could pay this April, whatever it is, 37,500 dividends, bringing you up to that 50,000 mark, but you could take that, later down the line. We want to use that 50,000 threshold each year. Next one, if you're earning a bit more, we're taking you up to the 100. And if you're doing really well, you pay way over, it doesn't really matter so much because you're earning fantastically well. So that's a key point we're sort of discussing at the moment, how we take our income out and keep it in line with those thresholds. So following that on a bit, a key point on that is your spouses. So as a business owner, I'm sure, I've never come across it, to be honest, and I'm sure everyone's partner in some form or another is involved in their spouse's business, whether that's going to networking events, social events, or even late in the evening, bouncing some things off one another. And what you want to do is you'd want to pay them a salary for that. So just like I did on the first slide, a salary between 8,788 and 12.5 to reward them as an owner of a business. So it's a way of you getting some money out of the business. They've got their own separate national insurance thresholds. So it's a good way of getting money out into your family's name, if you like. So if as well that spouse isn't earning as much as you or doesn't earn at all, so they're not using their personal allowance, fantastic, that 12.5 is tax-free. If they're not using their full 50,000 band, well, can we give them some ownership in the company? Can we give them some shares so that they are able to be paid dividends, making use of your joint bands? Yeah. So if you take someone, for example, that was earning 100,000 out of the business, taking out as dividends, and their wife's not earning anything, it'd be much better to give them half of the shares in the business, pay yourself 50 and pay them 50, and the highest rate of tax you're going to pay there is 7.5%. Take that to example, if you didn't do that and you were just taking out the 100,000 yourself, well, 50,000 of that income is going to be at 32.5%. You're effectively saving 25% on 50,000 by shifting the income between you both. I mean, I'm the numbers on myself, but anyone here can do a quick calculation on what 25% saving on 50,000 is. It's a big number. So I'll drum on this quite a bit, but making use of spouse allowances is a very key point in tax planning. Jumping on to sort of the next section, benefits in kind. So the two big ones at the moment are probably private medical insurance and gym membership. So these are maybe not for everyone, but most people will pay these sort of items anyway. So they take money out of the business, they pay some income tax for that money they've taken out, and then they go and fund these subscriptions and insurances anyway. So you're paying that money out of taxed income, if you like. So if your private medical insurance is £1,000 a year, you probably need to earn around 1,800 or 1,900, or sorry, take that out of the business, pay the tax to leave you with £1,000 to pay it anyway. A good way around that is getting the company to liaise directly with the insurance provider or the membership, and the company pays for that, benefit on your behalf. There is still income tax, so whatever the value of that benefit is still taxed on you, but you're taxed on the value of what you're receiving rather than having to take an inflated amount out to cover the payment, if you like, if that sort of makes sense. In addition to that, the company actually gets corporation tax relief on those expenses. So if you put through a private medical insurance for the business, that's a cost to the company. The company receives 19% corporation tax relief on that. So gym membership and private medical insurance are really good points. And the key point on those two is that the company has to be the one that liaises directly with those providers. You can't do it yourself and then reimburse you from the company. The company has to be the one with the contract. Company cars is a big point, and for the last probably 3 to 4 years, we've pushed people away from company cars. Company cars isn't how you'd expect. It's an illogical way. They work out this benefit in kind charge, so the amount you're subject to tax on. With the private medical and gym, you're taxed on whatever the value of those memberships or insurances are. A company car is worked out completely different. It's a bit of a funny way. Basically, you take the list price of the car when new, so regardless of what its current market value is, regardless of how old it is, you take its price when new times by a percentage based on a HMRC rate, and those percentages increase the more CO2 emissions a car has. So the less fuel efficient a car is, the more or the higher the benefit in kind charge would be. And what you ended up with is you had someone that was probably paying costs every year, leasing costs and that of 3,000 a year, but their benefit in kind charge was about 12 to 15,000. So they'd be taxed as if they were receiving about an extra 12 or 15,000 out of the business, compared to actually their actual benefits 3. So it was just, to be honest, a nonsense. You just wouldn't have company cars in the business. However, last year, for electric cars, they work fantastically well. And what it is that percentage charge at HMRC, how HMRC calculate the value of that car is, for electric car, I think for this year it's 0%. From April it's 1%, and the year after I believe it's 2%. So what does that mean? Well, if I had a £50,000, I'll give you an example. Tesla's a good one. A 50,000 Tesla. Next year, 1% of that will be subject to tax, so £500. Well, the company can fund all those costs, so it can pay your leasing costs, it can pay your insurance, your road tax, your repairs, MOT, without any income tax apart from this £500. in addition to that, if it's lease, you can actually claim 50% of the VAT back. So the company can fund all your car costs for a charge of £500 a year. So for electric cars for the next few years, if you're like me and live quite away from the office where the mileage isn't great, you probably couldn't do it. But if you live relatively close to where you work or that, an electric car is a fantastic thing to put through the business at the moment. Finally, own the business expenditure, and this applies not just to corporates, but for anyone that's self-employed in on this webinar. So if you're self-employed, the sort of usual expenses that sometimes go missed, and you do in your everyday sort of business life, but you probably don't even think you can claim from. One is business mileage. So if you go and see clients, you go to a networking event, you go to a training event, you go and see your accountant, that's business mileage. It's all in conjunction with your business. You can claim 45p for every mile there and back, up to 10,000 miles on those business miles. So definitely worth, if you're doing that, keeping a log of that. Mobile phone, especially with the working from home, the COVID situation. If anyone's like me, I'm always on the phone. I'm pretty much all the time. My phone is used for business. I'm on calls, using it, speaking to clients. The business can pay for my mobile phone. Ideally, the contract would be in the company's name, but HMRC don't really take the point. So even if the phone contract is in your name, the company can reimburse you for those costs. And what is a reimbursement? It just pays you whatever you've paid out on your phone. So if we're coming to the end of the year, you spent your phone bills wrapped up to £600 over the course of the year, the company can make a payment to you now, £600, tax-free. The company actually gets tax relief on that as a cost. So a good thing to consider. Use of home, again, COVID related. Everyone's sort of working from home at the moment. As any employee, so as a director as well, you can pay yourself £26 a month. You can do it in one lump sum if you want, or do it over the course of a year, but you can pay yourself £26 a month to cover your use of home, your utilities, because you're working from home more. We as a practice do that as standard procedure when we're doing the account. So if it hasn't physically been paid, we credit to a loan account. And the other key point here is equipment. And I know this, if anyone's like me, again, I didn't have an office set up at home. I wasn't planning for this. So when lockdown struck, I went out and bought a new desk chair, printer, another laptop screen to sit alongside a little filing cabinet, all those sort of things to work efficiently from home. Now, I don't use them socially. I didn't really want them in my house, to be honest with you. But now these are fundamental for M J Bushell for me to work. Well, the company can pay for those. So I've paid for them. The company can reimburse me for those expenditure. It can claim the VAT back on those costs, and it can also claim all those costs as a tax deductible expense. So if I've spoke to clients recently and thought, I didn't know that. If you've bought a desk, chair, all those sort of things, you can put them through the business. And that's the same as someone that's self-employed as well. If you're self-employed, you can still claim for those items. So also on corporate planning, we're thinking here just for corporation tax. Capital allowances, I'm not going to jump into because I think Corner is going to cover that in his budget speech on the new super deduction that was introduced. So I'll skip that point. Research and development, R&D. I don't know if everyone here joined my colleague Matt Bain's webinar a few weeks ago, but he went into great details on research and development. And just to cover it off, it's a tax enhancement relief. So it works by enhancing your costs that you spend on qualifying research and development products. So if you have a project where you're trying to develop a new technology that's new, innovative, you can get enhanced expenditure on those costs at 230%. So if you've got any questions on that, please fire them at me, and I'll get you in touch with Matt from our other Matt from our office, and he'll be more than helpful on those sort of things. This is one of my favourite points, to be honest with you. Profit recycling, and I think this is going to become very, very key in 2 years' time when corporation tax changes. What is profit recycling? Well, if you have a company, you do your normal accounts, whatever profit you make on that, you pay 19%. You have the choice of when you take that money out. Completely up to you. You're basically choosing when to pay income tax. If you are planning to take that money out for investment activities, and the key one's normally property, so you want to build up a property portfolio, or you've already got one, but you want to add to it, you can use the funds your trading business has generated by moving that across into another company. So effectively, if you picture it, you'd have your trading business, And then on the right hand side, on the left hand side, on your right hand side, you have another investment company. And the money that your trading company generates is moved across into this new company to fund acquisitions. Normally property, it could be shares, but you're basically, because you're not taking that money out into your own hands, it's still staying in a corporate wrapper. There is no charge to income tax. So it's a fantastic way of using company money, not taking it out, but by funding investments. And what we're seeing a lot of these family investment companies, FRCs, where later down the line, the kids become shareholders of the companies, maybe the grandkids, and it's a vehicle to plan for, the family's future wealth, if you like. Pensions. So pensions, I could speak on this for ages, are just at the moment just the best way, the most tax efficient way of building wealth. What is a pension? I think what you've got to have clear in your mind is a pension is just a savings pot. That's all it is. It can be the actual underlying investment, and it can be whatever you want. It's just a savings pot. It just has an extremely tax efficient wrapper surrounding it. So every year you've got a limit of 40,000 a year you can put into a pension. If you're a higher earner, it does get tapered, but let's just stick with the 40,000. Again, if you've not used the last few years, you actually have a brought forward, but just to cover this off here, because we're short on time, it's 40,000 a year you can put into a pension. What are the benefits of a pension? We put 40,000 in a pension. The growth on that money is tax-free. When you reach the old age of 55, you can take 25% of that pot out tax-free. You also then have the flexibility on drawdown. You can choose as and when you take it. You might wait until you've stopped earning completely and take out parts below your personal allowance, tax-free. So you've got a savings pot that you can touch whenever you want when you're over 55. And an added benefit is that also that if whatever the value of that pot is, when you pass away, whatever's left is not subject to inheritance tax at all. So it passes down to your wife or kids or grandkids, all tax-free. But what's the benefits, or what's the tax efficient part in addition to those, if you'd like? And these are all when you actually put money into the pot. So on a company contribution, so the company's done well, you've taken out, we've maximised now 50,000, 100,000. We want to take some more money out of the business, but we don't want to pay our income tax. Well, the company can pay directly from the company account into your personal bank account, into your personal pension account. Yeah, so pension to company account to your pension account. So it's you've not got your hands on that money, but it's moved it out of the company and into your name. So no income tax. So the company actually could pay you 40,000 into your pension with no income tax. In addition to that, the company actually receives 19% corporation tax relief on that. That's a cost to the company. So you've actually got an extra cost in the business. You're actually receiving tax relief on that. So it's fantastic if you've got a company to use that, if you've got excess cash to fund your pension. On a personal side, if you're an individual on this webinar, if you've got salary, income, those sort of things, if you make a personal pension contribution, you effectively receive the income tax back based on your marginal rate. So if you're 20% payer, you receive 20% back. If you're 40% payer, you receive 40% back. If you're 45% payer, you receive 45% back. And this is how it works. So take a higher rate payer, for example. So they're earning over 50,000 a year. They paid 8,000 into their pension. The government would gross up by 20%. So you'd actually get 10,000 in your pot. So that's part of your money back, 20%. In addition to that, because you're a higher rate payer, you'd also get 2,000 off your tax bill. So you've actually cost you £6,000 actual cash to get 10,000 into your pension pot. So again, if you've got excess cash, and I do stress that point, excess cash, because it's not money you can touch if you need it. You've got to wait till you reach 55. It's a fantastic way of staying tax efficient. So on to the personal side, and personal individuals and how we tax plan for them. Well, bullet point 1, pension contributions. So I've just covered it off. Brilliant ways of avoiding higher rate relief you are. And the other point is that 60% trap that I touched upon at the start. If you're earning, say, 105,000, 110,000, well, if you put 5,000 or 10,000 into your pension pot, it brings you below that 100,000 threshold. So something that's 60% trap, you avoided it. So in that, my prior example where you're getting the income tax back at the rate you are, well, you actually jump up, you actually get 60% tax back on your pension there by making that contribution. So if you are in that threshold, you've just sneaked over that £100,000, it would be worth thinking about, well, can I make a pension contribution? So that's a key point for this end of the year as well, 5th of April. You want to get that in before 5th of April. If you're a sole trader, have you thought about incorporating? So, as I said earlier, companies pay tax at a flat 19%. You can choose as and when you take your income. So I always think in my head, I've always got the 80,000 mark in my head. So if you're a sole trader where your profit is probably 80,000 or more, you're probably better off, or tax-wise, purely tax-wise, by being in a limited company, because we'll pay 19% and we can manage your income every year and how we take it out. So you'd be far more tax efficient if you're earning profit-wise over 80,000, if you can be, because I've got a few barristers that can't always be, but running for a limited company. Spousal allowances, again, I've touched on this before. So from a personal point of view, if you've got properties, investment shares, high interest bearing accounts, I mean, it's probably unlikely anymore you've got high interest bearing accounts, but if you do, looking at your spouse, who's the higher earner family, can we put some of those things in just in their names to make use of their allowances? You know, if you've got a spouse that's earning a lot less, well, let's put those high interest accounts into their name. Can we move properties into their name? Capital gains tax, I'm really going to keep this brief because I'm cautious of time though, but there's not a massive amount of planning that can be done. I mean, the key point I always think of is you get an annual exemption in addition to your personal allowance of 12,300 every year. That's, if you think of it, a joint husband and wife, that's 24,000 every year, and normally it goes unused. So if you are planning on selling some shares soon, you know, you might think, actually, I'm going to sell some just before the 5th of April to get my 12,300, and then I'll sell a bit just after to use up other 12,300 up. It wouldn't, you know, if you waited and sold, say, 25,000 in May, well, you'd only have 12,300 of that tax free. If you waited, if you brought part of that forward, you'd exempt it all. And just to cover it off, capital gains only applies on the uplift in value. So it's the price you bought something for compared to what it's now worth. So the main ones are shares and property. So what you originally bought it for to what it's grown in value. Continuing on the personal tax planning side, properties. Property is such a big one at the moment. I get so many questions on this, and we deal with lots of fantastic mortgage advisors and people in property. And it's a brilliant way at the moment of, well, it seems to be, of growing your wealth. So if you've got a property portfolio, the sort of things we're looking at is, you know, can we get them in joint names? If you're a really high earner, you may be earning over 100,000, your spouse doesn't earn anything at all, well, can we put that property into just their name? So give them 100% of the rents. The mortgage interest restriction has hit landlords this year really hard. So we really, you know, you have got to make sure we are trying to stay as tax efficient as possible and make use of that. Moving stuff into spouses is a key point there. The other sort of things you might want to do is invest in commercial property. Not sure if London is a good shout anymore, but or whether that's still risky, or furnished holiday lets. So that mortgage interest restriction, where you don't get the full tax relief on your mortgage interest costs, doesn't apply to commercial property or furnished holiday lets. So if you're someone that has a portfolio where you have commercial property or furnished holiday let and normal rental properties, look at the mortgages on them. If the commercial property or FHL has got, you know, barely any mortgage on it, and the rental properties have high mortgages, well, why not, when the remortgage is coming up, why don't we transfer them into the commercial property or the furnished holiday let? You'll then get the full interest relief on those properties, rather than if it sticks with a rental property where you're only getting a proportion. Other key point is, you know, companies. If we're going to build up a portfolio, using a company structure to do that. A company pays tax at 19%. If you're a 45% taxpayer, you're saving, you know, 16 to 25% tax by having it in a limited company. It allows you to build up cash quicker, to pay down the mortgage quicker, to build up a deposit for another property purchase. I'm going to have to speed up really quick now because I'm cautious on time. There are tax efficient investments out there. So investments where you put some money in and you get some tax relief for that. EIS, SEIS and VCT are the key ones. I won't go into great detail on them. I normally don't advise people to go with them. They are risky investments, but you do get some income tax benefit on those. ISAs, so coming up to the end of the year, every tax year, you can put 20,000 into an ISA. The growth on that ISA is tax-free. So if it grows in value, it's tax-free. If it earns some income, it's tax-free. So that limit is lost annually. So if you want to put some money in a tax-free environment, that's for you. Just to be clear, ISAs are not free from inheritance tax, though. It's just income tax. Lifetime ISA, this is a brilliant one. I think if you've got a young family, kids that are trying to get on the property ladder, I know most parents in some form or another start to put money aside to help their kid move out, to fund that deposit. A brilliant thing at the moment is lifetime ISA, where you can put 4,000 into that ISA, and the government will top that up by 25%. So you put 4,000 in, you'll get £1,000 from the government. So £5,000 goes in. That's the maximum you can put in there. That's tax years. So you could do one before this 5th of April, one on the 6th of April, and you've suddenly got 10,000 in there, 2,000 from the government. The ISA itself grows tax-free. So if it's in interest, the interest is tax-free. If it's in stocks and shares, the growth in those shares is tax-free. And what you can do is that ISA is you can only withdraw that money on one or two things. You reach 60 retirement age, you can take it out, and you can take it out tax-free, or you can use that to fund your first home. So if you've got young kids that are trying to get on the property ladder and you're putting money aside, well, why not get them to set up this account and pay that into them? You're going to get a grand a year from the government to help them fund a deposit. So I think it's a fantastic plan opportunity there, and leads into my next slide. I mean, I've covered here the EIS and SEIS, the details. So we'll send the slides around afterwards, so anyone can have a look at them. I won't go into detail here. So just following on for that, this is where inheritance tax comes and giving some money away. I mean, before we get into the tax side of it, I think the key point for me, whenever I'm speaking to anyone, is being smart planning for your family. Forget tax. Let's make sure if something does happen to it, our family is provided for. Both, there's no stress on them in having to sort things, and they've got maybe, know where everything is. So key points here is up-to-date wills. You've got to have up-to-date wills. I mean, if COVID doesn't put things into perspective for people, I don't know what will. You've got to make sure you've got a will in place. There's nothing worse than dying without a will when your partner, kids, and that are struggling, going through the stress of trying to get access to money or a title. It's a real nightmare. Powers of attorney. There's two, health and financial. So if something devastating was to happen to you, you became incapacitated. Can someone manage your affairs? There's bills that need paying. Who can access your accounts to settle those bills on your behalf? Well, without a power of attorney, no one. Health, if you need care, who's going to make those? If you're incapacitated, who's going to make the decisions for you? So a power of attorney are a key point to go alongside your wills. Another key point is joint accounts, and I've really got to stress this because I've seen this in the past, and it was a nightmare. It was probably an old-fashioned thing. The man of the family was very wealthy, he'd earned really well, and he had all the bank accounts in just his name. The wife, if you like, was just given cash as and when she wanted it. He sadly passed away. Well, she had bills to pay. Because what happens when someone passes away, all those accounts, if you're in someone's names, are frozen. She couldn't access the money. So that is a real problem for someone. They'd have to go through all the probate steps and everything to try and get, which is a long process, just to get hands on some money to settle some bills. So joint accounts is a way of stopping that. So if someone passes on a joint account, you've still got access to that money. And then the final point, life insurance. It is what it is, insurance. If something happens to you, your family's going to get a sum of money, whatever it is, to help pay off the bills, the mortgage, inheritance tax if there is any. And if you're relatively young, you can start planning towards that, and it's quite cheap. But you've got, like a safety blanket, a safety pot to help plan for your family if anything was to happen to you. On the tax side, every year you can give away 3,000 a year tax-free. No income tax is also inheritance tax-free. If you haven't used the previous year, you can also use that. So you've got 6,000. Gifts out of surplus income. So this is for individuals that are probably retired, but they've still got they still earn a lot. Maybe that's their pensions. They've got old annuities. They earn really well, but they don't spend it. So they're maybe earning 100,000 a year from all these pensions and that, but they're only spending 20,000 of it. They've got 80,000 a year of excess income, and all that's happening is that is adding to their estate pot. So when they pass away, they're building up this cash. It's going into savings pots. When they pass away, the government's going to grab 40% of that. Just if not worse in the position, you can give away every year gifts out of surplus income. So if you've got surplus income, so income you're earning but you're not actually spending, you can give that away tax-free. No income tax, again, no inheritance tax. Pensions, I've covered this before. Pensions are not subject to inheritance tax. So I've seen this in the past. Someone, if you've got assets elsewhere that are generating an income for you, and you don't actually need to touch your pension, would turn that tap off, and you don't need to take that pension. by taking it out, you're paying income tax, and then when you pass away, if it's sitting in a bank account, you're going to lose another 40% of it. Well, switch that tap off. If I don't need to take that money, leave it there. It will continue growing tax-free, and when I pass away, it will pass to me kids or wife or grandkids tax-free as well. And then finally, because I know I've been waffling on for quite a bit, trusts, not so much tax planning on trusts anymore, more protection of assets. So if you do want to start giving some assets away, but you're worried about maybe your children's spouses, or basically you're just worried about them, giving them those sort of assets, a trust allows you to give something away, start that 7-year clock ticking, but still retain a degree of control over it. And so it's a legal protection wrapper. So I think I've covered all my section here. I'm going to hand over to Corne now, who's going to be covering the budget.
Thanks, Matt. Hi, everyone. Yeah, so I'll be taking over the second part of this webinar, where I'll just be running through some of the key changes in the budget. So this will be about 10 minutes or so. I'll try and keep it brief, and then we'll give some time for questions at the end. So the budget was delivered a couple of weeks ago, so on the 3rd of March, and there were key changes in there to business and personal tax. But also what's still to come is that the government will announce a series of tax consultations next week, where we'll get a better idea of where they're heading over the next few years with certain taxes. Okay, so if we get started. Yeah, Matt, if I could have the next slide, that'd be great. Okay, so the first one, so the big one was the corporation tax. So there's a new rate for company profits over 250, which will be 25%. So with profits under 50,000, that will continue to be taxed at 19%. The profits falling in between that will be tapered, and the new rates will come into effect from the 1st of April 2023. So this was arguably the standout policy from the budget, and it's a huge change in how we as accountants will approach tax planning and assessing the benefits of running a limited company. So the new rate of 25% is aimed to target the larger, more profitable businesses who some will argue can afford to pay more. So and then the change doesn't come in for 2 more years, so we've still got 2 more years to enjoy lower corporation tax rates while all businesses recover from the pandemic and also post-Brexit environments. And so how the new CT rate will be calculated. So it'll be split across associated companies. So at the moment, the associated company rule is used to calculate whether a business will fall into paying corporation tax instalments. So something similar will be used for the new CT rate. So, for instance, if you had 2 businesses which make taxable profits of around 200 each, if you look at them individually, they won't be paying 25%. However, if they are associated in a group under common control, then the actual £250,000 paying the higher rate of CT will actually be reduced by the number of associated companies. Then, so this leads on to a question which we expect to be asked a lot over the next couple of years. Should we disincorporate? Is it worth becoming a sole trader, switching to an LLP structure? And well, the answer is not necessarily, and it depends. So, for instance, would it be beneficial to change to an LLP? So, if as a business owner you always strip out all the profits you make year on year, this may be an option, as in an LLP you are taxed on the profits you make, not what is actually taken from the business. So if you're taking out all the profits anyway, you're not using a limited company for one of the main benefits is therefore. If, for instance, you make good profits in your company and would be affected by the new higher CT rates, however, you leave a lot of the profits in there and you strategically manage what you take year on year, then a limited company definitely still has its place, and you can continue to do this, especially if you would fall into the higher rate, £100,000 plus additional rate tax bands if you were an LLP. Also, when it comes to splitting the profit in an LLP, it's not as straightforward as a limited company. For example, a couple can split their shareholding between them 50-50 in a limited company. Dividends are split between 2 people. And yet you utilise both persons' basic rate bands of both people. So there's absolutely no problems in doing this. However, for an LLP, it's not that simple. You almost have to justify to HMRC that the work done by each member in the business justifies their profit split. So in a couple of years, if we see a wave of new LLPs being set up, that are split 50-50 husband and wife, but only one side actually does all the work, then I can expect there being a few challenges from HMRC on that one. I know Matt really touched on it earlier, but yes, the big one, there's also a super deduction on new qualifying plant and machinery, which will be introduced for 2 years, 2 years only from 1st of April, so in a couple of weeks' time. And there's also a change in the special rate relief, which makes it a lot more generous than it was before. So this is really a tax incentive to encourage business to invest in capital items and kind of get the economy boosting or up and running again. So the super deduction will provide companies with a deduction that exceeds the cost of the qualifying asset. So not all expenditure will apply. There is criteria. So used and second-hand assets won't be included. So yeah, if anyone else is out there thinking of making purchases, capital purchases in the next couple of weeks, it's probably going to be worth, well, if you can, hold off, and then you'll receive some extra CT relief just by literally putting it back a couple of weeks. Okay, if I go to the next one, please. So another one is also the furlough scheme. So that's been extended to the 30th of September. It's been kind of a lifesaver for a lot of people over the last year. And so nothing's really changing. You can still claim 80% of employees' wages up to 2,500. But from 1st of July, there will have to be some employer contribution to that. So I think it's 10% from 1st of July, and that goes up to 20% for August and September. Okay, there's also the changes to corporation tax and income trading loss. So usually if a company or it made trading losses, you can carry that back to the previous year and offset against prior year profits. And that as what has been the rule for many years. And what the change now is that because I think HMRC and the government are expecting a lot of losses to occur during the pandemic year, or a couple of years actually, they're basically allowing people to carry back up to 3 years. So we can go back into 2018, 19, use those profit years and offset the losses you make over the last couple of years against those. The next point is, so this has kind of been, it's a big point, and it was brought in very quietly, is that HMRC will have new civil information power to obtain information from taxpayers. They can almost kind of bypass tribunals and courts to get that information. So it gives them the key to kind of start investigations and check up on you without really gaining your authority to do so. So that is, we'll kind of see where that heads over the next couple of years, but we do expect HMRC to use those powers as soon as they are given them. Next one would be VAT threshold, no changes there. It's still 85,000 for registration, 83,000 for deregistration. On to the personal tax. Okay, so the first 2 points here, there's not really much to say other than the rates have been frozen. So CGT, annual exemption, IHT bands have been frozen for the next 5 years. And the second point there would be the freezing of the personal allowance, the basic rate, and high rate bands. So although it's not really an increase, a decrease in the bands, just by freezing them for 5 years, it's almost a stealth tax, and it will naturally bring a lot of taxpayers into the tax paying threshold, so above the 12,570 and also over 50,000. So that will raise a lot of tax over the next few years without being seen to actually reduce the rate of the bands. Use of home payment, £26 will continue until next April. That was so you're eligible for the full £26 a month if you work more than 101 hours a month from home. The fourth point there would be the stamp duty. So this has been extended by 3 months. It was a big policy when it came out, because it could be a £15,000 stamp duty tax saving if you're buying a house more than £500,000. So that's been extended to 30th of June and then tapered off slightly to the end of September. Then temporary, the reduction in VAT for the hospitality and tourism businesses will be extended by 6 months, and then followed by a 12.5% rate for 6 months after that. And the reduced rate, was brought in to encourage people to go out, spend money on the businesses that have been struggling. So this will be very welcome for all those businesses who will really need to have a much better 2021. Final couple of points would be the self-employment support scheme. So this support scheme was brought in last year to be the self-employed equivalent of the furlough scheme. So to date, there have been 3 grants provided to struggling self-employed businesses. And over the next 6 months, there will be a 4th and 5th grant to those eligible. So the 4th grant has been set at 80% of 3 months average trading profits. That will be designed to provide support from Feb to April 21. And there's also going to be a 5th grant, which will cover the period May to September 21, which is almost in two sections. So for those whose turnover has reduced by more than 30%, you'll be eligible for the 80% support. However, if their reduction turnover was less than 30%, you'll only get 30% support. And the final point there is clawback from HMRC regarding relief that was handed out to self-employed individuals who were entitled to it at the time of the claim, but whose circumstances have subsequently changed and would no longer be entitled to it now. So the criteria for ceasing to be entitled are not actually set out, but are likely to be that basically the trading profits turn out to be higher than what you said they were when you claimed the relief. So those are the key budget points I brought in there. I do understand, just try to keep it very brief for time purposes, but there are a few other measures out there, and we have some information on our website for that. And yeah, I think that's it for the budget. And yeah, we'll go to the Q&A. So if anybody had any questions, more than happy to answer them now.
Great. Well, thanks very much, Matt. Thanks very much, Corné. We'll go on to our Q&A session now in the last sort of few minutes that we've got. And we have got quite a lot of questions coming through. So let me start working our way through those. So first question here from Richard. Thank you, Richard. When making withdrawals from my business, should I worry about whether I describe them on the payment narrative as salary, dividends, or something else? And do I need to make payments at that time to my wife, or can that be adjusted at the year end?
So I mean, I'd class them probably, Richard, as drawings. So rather than giving them a narrative as salary or dividends, I would just put them through as drawings, and we will cover at the year end with a mop up of salary and dividends. So that's the way I would do that. It grand scheme of things, it probably doesn't really matter. But strictly speaking, if HMRC wanted to look at your books, very unlikely. If they saw something going through and saying you class it as a dividend, they could argue a dividend was actually declared then. So I would do it as drawings, and then when we do your accounts, we'll post the individual entries in. On the wife query, if she's being paid genuinely, so as I said, the salary or dividend, then that should be paid direct to her, either into her own personal account or it comes out into your joint bank account. So she should be, the account that payment goes to she should be named on it somewhere. I think that covers that, Joe.
Great, thanks very much. Okay, another question here, which again I think is for you, Matt. If you decide to go ahead with private medical insurance through the company, can you provide that benefit to your children as well? And do you have to open it up to all employees? That's from Paul. Okay, Paul. Yes and no. Yes, you can put your children on it. If your children are already working in your business, they're employees, the benefit goes on them. If they're not, then that benefit's just assessed on you. So whatever their premium is just, it's added onto your policy, if you like, and you're assessed to that. You don't have to open it up to employees. You can just do that for your family and the other directors. So quite an easy one on that one, I think. Okay. Question here from Zoe. Can you have a lifetime ISA and a normal ISA in the same year? You can have two separate types of ISA. I'd have to check the point where you can set them both up in the same year. So I'm not sure if you can set the two different types up in the same year. But that lifetime ISA payment band, if you like, the 4,000 eats into your allowance each year on the ISA. So across all ISAs, you can put 20,000 a year in. So if you put 4,000 into a lifetime ISA, that drops to 16,000. The point, and I'm not sure, and you'd have to check, is if I've already set up a normal ISA in the year, can I still set up a lifetime ISA in the year? Because you can normally only set up, I think, maybe one in 1 year. So I'd have to check that point. Okay, absolutely fine. I've got one here, which I think is more for you, Corné. On the issue of the corporation tax announcement in the budget, do we know when HMRC or how HMRC are going to calculate corporation tax if you fall in that taper relief band?
So we haven't been given the calculation yet. So before the corporation tax, we used to be a flat 19 and then also a flat 20% before. There was, I think, 6-7 years ago, like a taper relief back then. And the actual calculation for the taper relief, it was actually quite punishing. It was actually towards the higher end anyway, but HMRC haven't actually released the information for that, but it's something we will find out soon. Okay. Another question here, as a director on furlough, can you still take a dividend? Do you want me to ask that, Corné, or do you go? Yeah, Matt,
yes,
you can take it. Yeah, but the answer is yes. Yeah.
Yes, you can.
You can. Okay, thank you. Okay, and I've just got one final one, which I think is a really good question that's come in here from John. What's a good age to start IHT planning?
I think for the, my first step, if you like, the planning in terms of smart planning, wills and that, there is no right age. I think once you've got assets, property in that, home, you should have those wills and that in place. In terms of actually the tax side, which whenever you feel comfortable. So with IHT, it's not your tax to bear; it's your children's tax. So you'll never have to pay it. You'll be gone when the tax comes due. So if you want to sort of start planning, I'd say you should have an awareness of it from 60. You should have an idea what it is. But in terms of actually giving things away, it's whenever you feel comfortable. I think if you leave it to your late 80s, there's a 7-year clock basically where you have to do things. You're probably too late. But between 60 and 80, you want to have an idea, and that's where you can assess what I should be doing and do something or not. Again, it's not your tax to pay, so completely up to you.
Okay. All right, I'm very conscious of time. We've slightly overrun, but thank you both Matt and Connor for a really, really good presentation. Lots of useful advice in there, so thank you very much. To all of our audience, as I mentioned right at the beginning, we will make a recording of this presentation available on our website later on today. We have a couple of unanswered questions, sadly, because we've run out of time, but we can respond to those on a one-to-one basis afterwards. So I think there's a couple of questions. Sam, Sharon, we'll get back to you on those. And again, thank you very much, and look forward to our next webinar. Bye for now.
Thank you. Bye-bye.